Buy these 2 ETFs and add to them on a regular basis, and not only will you have a portfolio with a strong foundation, you will have a portfolio that is likely to grow for decades by making these the centerpiece of your portfolio. There are times to take risks in every portfolio depending on the investor. But if you want to have and be able to take risks, you got to have a strong foundation for your portfolio. I talk about this in my coaching program, my one-on-one coaching program all the time. Regardless of where you are as an investor, you got to take a look in the mirror, look at your portfolio and say, do I have a strong foundation for when times get tough, I have something to lean back on. And these 2 ETFs that we're going to talk about today do exactly that. So if you're excited for today's video as we look at 2 ETFs that you can buy on a regular basis and hold forever, then do me a huge favor. Click that like button down below, subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of any level, regardless if you're starting today or been investing for 10 plus years. You can go to fool.com/Mark and see their 10 best stocks to buy right now. Check out the link down in the description below. All right, let's get back to today's video, taking a look at 2 ETFs that we can buy and hold forever. Both of these ETFs complement each other in so many different ways. Let's begin with the ETF that is my largest position, and really should be the largest position in many investors' portfolio, which is an S&P 500 ETF. And when it comes to an S&P 500 ETF, there are many great options out there because there's many different brokerages that offer pretty much the same exact offering. 3 of the most popular are VOO, which is the Vanguard S&P 500 ETF. There's SPY, which is the Spider S&P 500 ETF. And then there's IVV, which is iShares' version of the S&P 500 ETF. So why are there so many different options? Well, as I just mentioned, there's different brokerages that make these offerings, and all of them collect what's called an expense fee, which is a fee based on how much you have invested on a market value for owning that particular ETF. These are called expense fees, and they vary from ETF to ETF, depending on if they're actively managed or passively managed. Here's a closer look at these 3 S&P 500 ETFs. As you can see, we have VOO, which is Vanguard's version, SPY, which is the Spider S&P 500 ETF, and then IVV is the iShares S&P 500 ETF. The first line, you could see the different prices for each of those ETFs. You could see the 5-year performance. Now again, they all track the S&P 500, so it should come as no surprise that they have the same exact performance. The dividend rates are exactly the same for all 3. Really, the only difference is going to come down to the expense ratio. For VOO, it's 0.03%. For SPY, it's 0.09%. And IVV, also 0.03%. Although the SPY expense fee is triple that of the other 2, we are still talking about extremely low expense fees. So this means that for every $10,000 you invest in these ETFs, for VOO and IVV, we're talking about $3 in expense fees. For SPY, we're talking about $9 in expense fees for every $10,000 in market value you have. So when it comes to which of these ETFs I like better, it's clearly going to be VOO or IVV since they have the lowest expense fee, right? Well, not exactly, because if you're an investor like myself that likes to dabble in options, particularly option selling, then you're probably going to like SPY just a little bit more. The reason being is that SPY has many more option contracts that are traded on a daily basis compared to VOO and IVV. Now, if you're a long-term investor, you're going to be doing none of this short-term options trading, well then VOO and IVV are probably going to be your best options. When you look at the options chain for 30 days out from today's video, you will see that IVV and VOO have open interest of roughly 150 or less contracts, looking at a strike price that's roughly 3% below today's price. However, on the flip side, when you look at SPY, we see open interest of over 20,000 contracts. So again, it really comes down to if you're going to be doing any short-term trading with either of these, that's how you can really decide which one is a better fit for you. So now that that's out of the way, now we want to look at why should the S&P 500 be a core position in your portfolio? Well, number one, it provides diversification. You're going to have ownership interest in 500 of the best companies in the world. Looking here, you can see the sector breakdown and how the exposure is spread out, with the top exposure being technology sector at nearly a 30% exposure rate. That is then followed by healthcare and then financials rounding out the top 3. Looking here at the top 10 positions, you can see Apple, Microsoft, Amazon, Nvidia, Alphabet, also known as Google, Meta Platforms, Berkshire, Tesla, and United Health. These top positions make up roughly 32% of the S&P 500, and in totality, they have 504 holdings. That's number one. Number two is the consistency that you get with the S&P 500. You can go back in history and look at any 20 consecutive year period and never find where the index came out on the negative end. The S&P 500 is as consistent as they come, and you can also get it with a low expense fee, even if it's the 0.09%. Owning the S&P 500 will give you a 1.5% dividend over the trailing 12 months with a roughly 5% 5-year dividend growth rate. ETF to buy and hold number 2 is the Schwab US Dividend Equity ETF, stock ticker SCHD. When it comes to this one, there's only one option you get, and it's SCHD. This is yet another fantastic ETF, although 2023 has not been kind for SCHD holders. Regardless, the ETF is still fantastic, and they currently have assets under management of roughly $47 billion, and on the year, SCHD is down 8%, which is not good considering the S&P 500 is up about 15%. However, the reason that I like SCHD is that it diversifies your portfolio in different ways from the S&P 500. Again, it's a great complement to the S&P 500. Where we saw the S&P 500 is a little bit more technology heavy, roughly 30% of that fund. You won't find technology until you get to the 5th largest sector for SCHD. And that's one of the primary reasons SCHD is trailing here in 2023. Looking here at the sector breakdown, you can see that SCHD has the most exposure to the industrial, healthcare, and financial sectors. The sectors are a little bit more spread out with SCHD, and technology accounts for only 12% of the fund. Again, the 5th largest sector. In terms of top positions for SCHD, you will find Amgen, Broadcom, Verizon, Coca-Cola, Merck, PepsiCo, AbbVie, Cisco Systems, The Home Depot, and Pfizer. These top 10 positions account for 41%, and in total, in terms of number of holdings, SCHD has 104 total positions. The main thing, though, is when you look here at these top 10 positions, you will find no overlap with the top 10 positions of the S&P 500. Although SCHD invests in S&P 500 companies, the top 10 positions, again, no overlap. When it comes to healthy stock market rallies, it tends to be a little bit more broad. However, in 2023, it's been anything but broad. It's largely been covered by 2 sectors, technology and communication services. And when you look at those exposure rates within SCHD, they account for roughly 17%. That's why you see the S&P 500 doing so well, because 30% of that entire index is technology. Only 12% technology within SCHD. There are many other great ETFs that are out there that come to mind, one of those being QQQ. But again, that has a ton of technology exposure. I'm already getting a ton of technology exposure with the S&P 500 alone. That's why SCHD complements the S&P 500 so well. It's much broader in terms of the industries and the exposure rates, although not overly exposed to one particular sector. But again, when you get those broad, healthy rallies, SCHD is going to do quite fine. In addition, the ETF has a low expense fee of just 0.6%. It also pays a safe and growing dividend that currently yields 3.8% over the past 12 months, and they have paid a growing dividend for over a decade straight. The dividend is also a fast-growing one, with a 5-year dividend growth rate of nearly 14%. When it comes to SCHD, it is updated by the fund managers 1 time per year. They go through and change out positions, so it'll be really interesting in March of 2024 to see how the fund managers change their technology exposure. Are they going to increase it a little bit more, or are they going to leave it down where it's that 5th largest sector? Something that I'm going to keep an eye on here in a few months. So both of these ETFs, whether it's the S&P 500 index or it's SCHD, are 2 high-quality ETFs that can be bought, added to regularly, and held to forever. You have multiple choices when it comes to the S&P 500. SPY is going to be a great one if you do want to dabble in options. VOO and IVV are two great ones for just buy and hold investors. And then to complement the S&P 500, you could look at SCHD, which again hasn't been great here in 2023, but when you get those broad market rallies, it's going to do quite fine as it has a lot more exposure, higher exposure rates to a lot more different sectors than the S&P 500. One reason it complements so well. In addition to that, you get a near 4% dividend yield, a fast growing dividend close to 14%. So it checks off a lot of boxes in terms of investors. You could be a growth investor, you could be a dividend income investor, and like both of these ETFs. Down in the comments section below, let me know what are your thoughts on both of these ETFs, S&P 500 and SCHD being core positions, buy and hold ETFs. Thanks again for watching. If you haven't done so yet, make sure you smash that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.